Pricing and volumes. These are the two features that have characterized the recovery being witnessed by steel companies as well as steel prices. And it's these two features that Citi is stating as a rationale in their recent report, a very positive one on Steel Authority of India or SAIL. Now, this report is coming in just a couple of days after SAIL has actually released their Q1 numbers. The numbers have not been great. In fact, the company posted an EBITDA loss on account of lower volumes, on account of the fall in prices, both of course being spurred on because of the lack of domestic demand, and in turn SAIL as well having to export more. But now Citi believes that the tide is turning. In fact, they're also opening a 90-day positive catalyst watch. The two key parameters being, of course, like I mentioned, pricing and volumes. So in terms of pricing, as we know, and we've been flagging off on ET now as well, since June and July, there has been a rise in Indian steel prices to the tune of almost 3,000 to 4,000 rupees per ton. Not just that, Citi also notes that HRC prices have already reached import parity. So that's the kind of momentum being witnessed over there. Further, they're also talking about how they expect now even long product prices to increase over the course of the next 1 month. So they're penciling in almost 1,000 to 2,000 rupees per ton. We know that SAIL does have a good portfolio of long products. In fact, they as well were contenders for the rail order. So this price hike would bode well for SAIL, no doubt about that. But on the volumes front as well, we know that even the domestic demand is recovering very smartly. SAIL too was one of the companies that resorted to exports because India's domestic demand was a little weak for steel. If we have to compare the margin profile of the products exported, or rather the pricing that these exported steel products carry versus the margin profile of steel sold in India, it differs in the sense that the domestic steel pricing is obviously a little higher in terms of margins. So now that once again that equation is rebalancing itself with exports going down and domestic sales increasing, that would benefit SAIL too. Furthermore, on the margins front, what will further boost margins from here on is the fact that coking coal prices are slumping, and there will be the benefits of scale that will come in because volumes will recover for SAIL. So that as well will be something that will sort of support EBITDA, support margins. Interestingly though, Morgan Stanley still maintains an underweight, while Citi, however, has upgraded the stock price of SAIL from a neutral to a buy. They're keeping their target price at 50 rupees. It was earlier at 40 rupees. But Morgan Stanley is keeping their target price at 43 rupees. But like I mentioned, Citi is essentially watching out as a positive catalyst watch for 90 days. So let's see how SAIL essentially delivers. The management has already said that, look, things are improving considerably. Let's see how things shape up from here on for this steel major.